Everyone is celebrating the new market highs, but most people are looking in the wrong direction. The common mistake right now is thinking this rally is built on a strong economy. But it's not. The key is to see what the data reveals about the next big market rotation. So if you only have a minute, here it is. The data is signaling a near-perfect repeat of the last 2 years, where a strong July gives way to a brief market cool-down. This isn't a crash warning. This is an alert for what could be the single best buying opportunity to prepare for the year-end rally. If you want to get ahead of these kinds of market shifts with analysis that goes deeper than the headlines, you might want to consider subscribing. My channel is pretty new, only a couple weeks old, but that's the goal here. My name is DataCat, and, well, for a long time my job was to be a data cat. I was an analyst inside a big Fortune 50 company, a real corporate slave, you know? My entire job was to ignore the PowerPoints and the big presentations and just dig into the raw numbers to find out what was really going on. I traded that life for, well, this one. I figure if my old bosses found this kind of analysis valuable, maybe you will too. So, let's get into it. Alright, so first let's talk about that good news that supposedly slammed the door shut on a July rate cut from the Fed. We saw a headline gain of 147,000 jobs. The unemployment rate ticked down to 4.1%. On the surface, that looks great. The market certainly thought so. But this is a perfect example of a strong headline with a really weak underbelly. When you pop the hood on that number, you see something else entirely. Of those 147,000 jobs, a massive 73,000 of them were government hiring. The private sector, the actual engine of the economy, added a pretty meager 74,000 jobs. And that number has been trending down. So why did the unemployment rate go down? It wasn't because a ton of people found work. It was because the labor force actually shrank. People stopped looking for jobs, so they're no longer counted as unemployed. The participation rate fell to its lowest point since 2022. This is a classic late-cycle signal. The market rallies on a hollow headline, driven by sentiment, not by fundamental strength. This makes the market very, very vulnerable. So if the economy's foundation is a bit shaky, what's holding this market up? In the short term, it's one thing: earnings. Specifically, the massive capital expenditure announcements we're expecting from the tech giants. CapEx is just a corporate term for the money companies spend on physical things to grow the business: buildings, equipment, and in this case, mountains of computer servers and chips. This week, we're going to hear from Microsoft and Meta. The market expects them to announce that they are spending billions and billions of dollars to build out their AI infrastructure. That money flows directly to the companies that make the essential hardware, like the semiconductor giants AMD and Nvidia. This AI-driven spending spree is the primary pillar of the bullish case right now. It's a force so powerful that many believe it can just steamroll over any of these broader economic concerns. This brings us to the big debate happening on Wall Street right now. Is this a fundamentally strong rally, or is it just speculative froth? On one side, you have analysts like Tom Lee.
Markets made new highs this week. I don't find a lot of people cheering and happy. Most of our institutional clients are skeptical of this recovery because they feel that there's still looming uncertainties, whether it's the FOMC or the tariff deadlines.
His main idea is that the market is climbing a wall of worry. He talks to his big institutional clients, and despite the new highs, they're all still skeptical. They're worried about the Fed, they're worried about tariffs, and they're sitting on a reported $7 trillion in cash on the sidelines. His argument is that markets don't peak when everyone is skeptical. They peak on over-exuberant enthusiasm, which he says just isn't there yet. On the other side, you have people like Cameron Dawson. She points to a report showing that speculative trading activity is at the highest level it's been since the dot-com bubble and the 2021 mania. She sees these wild parabolic moves in tech stocks that don't even make a profit as a clear sign of speculative fervor. This reminds me of, how sometimes a cat is a serious hunter, focused, patient, waiting for the real thing. That's a fundamentally driven market, but most of the time, you can get a cat to chase a little red laser dot for hours. It's frantic, it's exciting, but it's chasing an illusion. The question is the market hunting or is it just chasing the dot? The consensus seems to be that the core leaders, the big S&P 500 companies, are still hunting. Their fundamentals are strong. But there's a whole lot of laser dot chasing happening on the fringes, and that adds a layer of risk. Parabolic moves never end by just going sideways. Now this is where the data gets really clear. I want you to picture a chart. We're going to plot the market's performance for the last 3 summers, starting on June 1st of 2023 and 2024, considering these years share similar market context, which is AI, inflation, rate cut, etc. The first line is for 2023. It climbs steadily for about 50 to 60 days into late July, and then it rolls over into the August-September pullback. The second line for 2024 does almost the exact same thing. A summer rally that peaks right around that 55-day mark, and then a correction. It's a remarkably consistent seasonal pattern. Now here's the third line, 2025, our current year. For the first 50 days it followed the 2023 playbook almost perfectly, and in just the last week or so it has started to accelerate upwards, going almost vertical. And here is the crucial point. We are at the historical inflection point. The data is telling us that the highest probability outcome is a market peak right here, in late July or early August, followed by a multi-week pullback. This directly affects your retirement timeline and your portfolio strategy for the next quarter. So, what does this all mean for you? Let's break it down. In the immediate term, this week's tech earnings are the final potential fuel for this rally. If they come in strong, which is what's expected, it could give us that final push higher, a blow off top. Then, in the short term, for August and September, the weight of the evidence points to that pullback. A healthy, necessary correction that shakes out the speculation. This is not something to fear. This should be viewed as a buying opportunity. A pullback would reset the board and set up the next phase of the bull market. This is where we could finally see that rotation we've been waiting for. If the Fed does eventually signal a cut, that cheaper capital will be a huge boost for the small cap stocks and financials that have been left behind in this narrow AI rally. So what's the one level you should be watching? It's the 50-day moving average on the SPY. If the market pulls back and finds support, if it bounces off that 50-day line, it confirms this is just a healthy correction in an ongoing bull market. If it breaks decisively below it, that would be a signal that a much deeper downturn could be underway. So that's the story the data is telling. A market that looks strong on the surface but is running on fumes from AI spending hype and is sitting at a critical historical turning point. I hope this was valuable. The goal here is to give you the tools and the context to see the market for what it is, not what the headlines want you to think it is. If that sounds good to you, I'd appreciate it if you'd subscribe and join me for the next one. Stay curious and stay sharp. DataCat out.